Hi, my name is Doug Sullivan. I'm a certified exit planning advisor. Most of my career, I've been entrepreneurial, building businesses. And most of it in the restaurant industry. I started with the Olive Garden restaurants where I just had 2 locations. I was part of a Central Florida regional management group and developed Olive Garden from those 2 locations to about 400 locations before I left. And then after that, I started with Outback Steakhouse. Similarly, when they were just starting out, and I was part of a joint venture group in Central Florida. We built our group to 22 locations, but we were also instrumental in building the infrastructure for the rest of the company so they could support their growth. Then in 1998, I decided to take my experience and do it on my own. I created a company called Stonewood Holdings. I was able to raise investment capital, and actually it came in the form of a loan, a line of credit. It was a $10 million line of credit, and our initial goal was to open 3 locations. Well, we ended up opening 18 locations in 2 states. Built a company to $57 million of revenue. In the process, we created all the infrastructure to support that company. That was the accounting department, the marketing department, training development, construction development, constructing new restaurants, and also the entire management team with 2 regional vice presidents. And we eventually, after 10 years, decided that we wanted to recapitalize the company and or sell it. And so we put together a presentation book and pitched it to private equity. We eventually got offers as high as 8 times EBITDA. And I look back at that and I say, well, how did we get that 8 times EBITDA? Knowing in today's market, the average is probably less than 3. And I look at all that infrastructure that we developed and created with that company, and that's what built the value. That brings me to being a CEPA, and what is exit planning? Exit planning combines plan, concept, effort, and process into a clear, simple strategy to build a business that is transferable through strong human, structural, customer, and social capital, okay? CEPA is a community of people. It's a community of professional advisors, CPAs, wealth managers, estate attorneys, bankers like yourselves, M&A advisors, and business brokers. And in fact, M&A advisors and business brokers are a relatively small percentage of it, maybe 10%. We're collaborative, like-minded professional advisors. We have a common goal, which is to grow, preserve, transition wealth for business owners. And we focus on enterprise value, not just EBITDA or monetary value. We take a holistic approach. We look at what we call the 3 legs of the stool: the business goals of the owner, the financial goals of the owner, short and long term after the transaction, as well as the personal goals of that owner. What are they going to do after the transaction? We also look at exit planning as a process. Not focused necessarily on the event. It's more focused on the preparation for an event. Now, this process might take a path of continuing to grow because maybe they're not ready to exit. So it might be a 5, 6, 7, or 8 year process, or it might be a 2-year process preparing a business for a liquidity event, and then preparing the owner with a plan afterwards, a financial plan, and then preparing the business to make it transferable. So that's what exit planning is all about. Why today is this important? We're in the midst of an unprecedented generational transfer of wealth. It's going to impact us socially and both economically. More than 50% of boomer businesses owners are 64 years or older. 63% of private businesses are owned by these baby boomers, and 80 to 90% of their wealth is tied up in their business. Surveys confirm that 76% plan to transition over the next 10 years, 48% over the next 5 years. This is estimated to be a $10 trillion, and I've heard more recently, a $12 trillion transfer of wealth. Huge. So then, how are we doing? How are we doing so far? How are they doing as business owners transitioning? Well, 3 out of 4 business owners surveyed within 12 months after the transaction profoundly regretted selling their business. 70 to 80% of the businesses that are put in the market don't even sell. 30% of family transitions are not successful. So those are pretty bad, pretty bad response so far. Then let's look at the state of the owners. What are they thinking? Well, given this question, having a transition strategy is important both to my future and the future of my business. 99% either agree, strongly agree, or somewhat agree with that statement, 99%. Those same people, when surveyed, 79% have no written transition plan. 48% have done no planning at all, and 94% have no plan for themselves after a transaction. Recipe for disaster. So what's the solution? Value acceleration is a system or group of interconnected disciplines formed by the interaction of a collaborative, like-minded community of professional advisors with a common goal to grow, preserve, and transition wealth for business owners. So we look at this, there's got to be a paradigm shift. The way they're thinking now has got to change. Number one, we look at exit planning advisory as a holistic planning. There's the three legs to the stool, right? There's business, there's personal, and there's financial goals of the business owner. A successful exit strategy has three legs covered. Maximizes transferable business value, ensures the owner is financially prepared for that transaction and thereafter, and then ensures there's a plan, a personal plan for what he's going to do or what he or she is going to do after the transaction. Number two, we want to convey the thought process or change the paradigm that exit planning is something you do when you're ready to exit. We look at exit planning as a business strategy. It's just good business. It's going to improve the value of your company. You're going to be happy you're running your company. We focus on the four intangible assets: customer capital, structural capital, social capital, and human capital. We simplify the process and have a clear roadmap for you to follow to improve the valuation and transferability of your business. Thirdly, we want to adopt a custom framework. The value acceleration methodology is a proven process that focuses on value growth and aligning the business, personal, and financial goals of the business owner. And then lastly, we want to focus on transferability. We want to focus on enterprise value, not just EBITDA or monetary value. So, and our main, also, we want to convey to owners that they're leaving cash on the table because they're so focused on income generation, which of course is very important. It's what they're putting in their pocket, but it may not be transferable. So we want to get owners to focus on enterprise value and the transferability of that value. So let's talk about tangible versus intangible assets. Tangible, of course, refers to your balance sheet, all the information your CPA has given you, your EBITDA, or whether it's recast, whether it's normalized earnings, whatever, net income, whatever. Normally, we're focusing on EBITDA, recast, or normalized earnings. Those are your tangible assets. Your intangibles are the 4 C's, and in our opinion, make up about 80% of the transferable value of your company: human capital, customer capital, structural capital, and social capital. So value acceleration measures the value of these intangible assets. So let's talk about the 4 C's. I don't really have the time in this presentation to go into really in-depth in all 4 of them, but let's just talk about human capital. And you can see from this slide that human capital makes up a lot of different things. There's probably about 15 different items under human capital. We use a scoring card to score each one of those items. We rate each one 1 through 6. 1 being, heck, I don't even know what you're talking about. 6 being best in class, they're hitting on all cylinders. And so we look at each one of these components of human capital and we rate them 1 through 6. Now I'm going to show you a simplified process. Of course, it's not exactly like this, but we have, if we were to, let's say, rate and give them a 16 and the possible score is 30, then we would rate human capital at a 53%. We do the same thing for the other 3 capital areas. And then we look at, well, which company would be more valuable? Well, you can see from that, of course, if you've got 3s and 2s versus 4s and 5s, that from a standpoint of intangible capital, the 4s and the 5s would be more valuable than the 3s and 2s. That's just common sense. Well, let's look at it from the way the market looks at it. What the buyer is going to look at it. They look at that asset, that EBITDA transferring as risk. What is their risk that they are not going to be able to achieve and grow that number in the next 3 to 4 to 5 to 7 years? And so when they see risk, they devalue the company. By devalue the company, they devalue your multiplier. So if you look at the range here, about 45% is where many of the companies fall. they're going to get a 1 to 2, 2.7, 2.6 multiple. 58% is the median. They would potentially get a 3 to 4%, 3 to 4 times multiple. Best in class would have a rating of 72% on these intangibles, and we estimate that they would get a valuation of somewhere between 5 to 6 times multiple. Now, of course, when you get into those higher multiples, structure of the deal is going to come into play. In other words, rather than a cash buyout, there's probably going to be some type of a stock exchange or some kind of seller financing, but still the value is there in the business. So we take it one step further when we're talking to our business owners, and we talk about the profit gap. So if you were my client and you had $2.5 million of earnings in your company, I would look at your revenue. I would go into a database that we have access to, and I'd say, okay, well, within your industry, within your size of business, the best in class have 12.6% EBITDA. You have 7.5% EBITDA. If you were to take your revenue with that 12% in EBITDA, you'd have $4.2 million in revenue or EBITDA rather than 2.5. Then I take it one step further, and I look at the value gap, looking at those intangibles. And we estimate, okay, based on where you are with your intangibles, your transferable value, we feel you'd be at a 3 times multiple. Well, I go back to those databases and I say, okay, let's look at a similar company in a similar industry, similar size, and the best in class is getting a 7.6 or 7.65 multiple. Well, if I were to take best in class for your company at your EBITDA and best in class for your company in the valuation of the intangibles, you have the potential of market value $32 million as opposed to 7.5. Yes, that's the best case scenario, but still it's pointing out to the owner what the potential is if he's really willing to fully commit himself and take the time. This might be a 5-year plan to get them ready to go to market. It might be another year preparing them for market, another year to sell it. But if they're willing to commit themselves, this is the potential. So the end result is we want to prepare an exit planning report. An exit planning report is a 105-page report. It's a comprehensive and fully integrated planning tool designed to help owners achieve their exit objectives. Now that concludes my presentation. I'd like to open it up. I'm sure you have questions. Hope to have answers.